This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade FOREX Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here, wrapping up the week in the Forex. Today is Friday, April 20th, 2007. The U.S. dollar continued to fall this week, reaching its lowest in a quarter century against the pound sterling. Such weakness was mirrored in most other major currency pairs, with the exception of the dollar-yen. The dollar's tone is increasingly bearish, and many strategists expect that selling will continue as data continues to disappoint. Some of this week's mediocre numbers included CPI, industrial production, Empire Manufacturing, and the TIC report. Retail sales were in line with estimates, and housing starts came in slightly better than anticipated. These are hardly numbers that have the potential to spark any rally in the dollar. Meanwhile, the UK posted its strongest CPI data in a decade, and BOE minutes showed that two members voted for a rate hike earlier this month. Data out of Canada and the Eurozone also indicate that a U.S. slowdown has done no damage whatsoever and offers traders a sound fundamental outlook. Additionally, we haven't heard much protesting from foreign officials about the strength of their currencies. This removes the chance of verbal intervention, at least in the short term, leaving the door wide open to further gains at the expense of the dollar and the yen. Now to the big picture. In last week's big picture, we discussed what could be highlighted in the G7 statement and the influence it might have in this week's Forex. The statement was in line with what many traders were expecting to see and has really done little to alter our outlook. A call for stronger Asian currencies and a global effort to curb enormous trade imbalances was made, but the Japanese yen was not specifically targeted. A handful of attendees mentioned interest in addressing yen carry trades and the unfair advantage the currency's weakness offers Japanese exporters. However, the communiqué merely warned against one-sided bets in foreign exchange and suggested that exchange rates should reflect all underlying fundamentals. It was also clear that foreign and U.S. officials see a further decline in the greenback as a key factor in reducing deficits. Moving forward, we believe that G7 participants may have their wish granted, as traders are being offered almost no reason to buy the U.S. currency, even at historical lows. Not only do we still have huge structural problems with deficits, but the U.S. is also falling behind the eight ball in growth and interest rate expectations. Any further signs of deterioration in the U.S. economy could really cause a panic sell-off in the buck. While we're not predicting the greenback to fall another 10% this year, we certainly cannot rule it out yet either. Till next week, have a wonderful weekend and take care.